Joining me now is Cobus Potgieter from Southern Cross Capital to share his analysis on the day's market performance. Cobus, thanks so much for your time this afternoon. So sentiment pretty mixed, but some good news coming through, right? On the economic front, it seems like we will be getting that U.S. inflation print despite the government shutdown. So the Fed not going into that next meeting totally blind, right? As they'll have at least one half of that picture.
Yes. I assume there is a bit of data that is not necessarily being released by the Bureau that the Fed, will continue to have access to. But overall, less than ideal that we are getting fewer and fewer data points because, as we know, given the deal mandate, of course, there are labor issues that we're not getting an insight into that also drive the Fed's decision ultimately. But in any case, it looks like the market is broadly expecting flat inflation period on period for this next announcement next week.
And just on that inflation picture, I was sifting through some of the surveys around consumer sentiment. The New York Fed survey in particular revealing that consumers are expecting inflation to be higher this year. Is that a cause of concern when it comes to, I guess, the central bank's easing cycle, right? Because here we are, we're dealing with that double mandate where, labor or hiring is slowing, but on the other end, we still don't know the trajectory, the exact trajectory of inflation with, the tariffs also hanging in the balance. We're still waiting on that impact as well.
Yes. So, the consumer is largely driven by the news they see, and what they see in front of their faces is, of course, U.S. trade policy. So I think there's a broad expectation for high inflation baked in. Sometimes high inflation expectations does lead to higher inflation. We know there's a bit of a feedback loop there, but ultimately, it's you're right. It is a murky picture. The jobs market is certainly cooling, and at the same time, we also have political pressure from both the White House and the rest of the Republican Party, essentially pushing for cuts, regardless, it seems, of the mandate of the Fed, or the inflation mandate more specifically. And by May of next year, there will be more Trump appointees serving on the Fed. So, there's a little bit of a credibility gap forming as well. But I suspect, given all of this, on balance, I suspect we will see further cuts before the end of the year, despite the inflation outlook not being all that rosy.
All right, let's move over to news that we're more certain about, right, where we actually have the numbers, company news. Ferrari out with an update overnight after and announcing that it's updated its guidance. That, however, failing to excite investors. It's posted its worst trading day ever. They've also scaled back on some of their EV ambitions. Considering that this automaker also plays in the luxury space, one would expect the counter to do well. What's going on there?
Well, the counter has done phenomenally well. Let's be clear. It has certainly, since its listing, surpassed expectations enormously. And I was just looking at these numbers. The major disappointment was essentially that management are anticipating achieving an EBITDA margin of 40% by 2030. Just to give you an idea, the rivals in Europe are achieving in the low teens and into single digits on the same metric. Ferrari sitting at around 38%, and the market was hoping for them to achieve up to 42%. From an operating profit level, they were achieving between 4 and 5 times what their European peers are. So some of those expectations essentially being dialed back relative to previous capital market days.
Okay.
And the transition into EV has been very, very difficult for all of the luxury marques that have attempted it. It seems that those buyers aren't as fond of the idea of going full electric and paying millions of euros for electric vehicles. They're more traditional. So the market seems to be very uncertain around Ferrari's strategy into transitioning into fully electric, something which they are only going to start dabbling in now.
All right, let's move over to one of the key metals when it comes to those hybrid vehicles, that being PGMs. I noticed that PIC picked up more of Sibanye's shares, bringing its total holding to just over 20%. Are we seeing a shift when it comes to those PGM counters, particularly from institutional investors, on the back of the rise we've been seeing in your platinum and palladium prices recently?
It does seem to be the case, absolutely. So as you've alluded to, again, that the transition to EV has cooled. It is still growing. So electric vehicles as a total proportion of total vehicle sales is still expanding, but not at nearly the rate it was expanding a year ago, 2 years ago, 3 years ago. And ultimately, hybrids as a proportion of the whole is expanding quite aggressively. So a hybrid, of course, being a combination of the traditional internal combustion engine paired to a much smaller battery EV type motor inside of the same vehicle, purporting to provide the best of both worlds. Now, the traditional, highly efficient petrol motors that these things are paired with utilize platinum group metals inside of their catalytic converters. So that ultimately has really been a shift in the expectations for the PGM space. And it seems that the institutions are starting to bet that this will be a longer term trend, not just a blip or a brief slowdown. The pace of EV adoption, full EV adoption by 2030 or 2035, as some economies have targeted, is highly unlikely. And we're likely to see those hybrids and traditional ICE vehicles being a significant piece of the pie into the foreseeable future for at least another 2 or 3 decades. And on that basis, that's bullish, given how little investment, precisely because of the strength there has been in expanding PGM mining. So those companies that still continue to mine those, even though the capex hasn't been enormous, the value of the commodity is going to be relatively higher, and that's enormously beneficial. And as you've mentioned, the PIC and a bunch of offshore institutions as well have clearly been buying into the narrative that platinum will be supported going forward.
All right, let's hit pause on the conversation. Before we move on to your stock pick, let's take a moment to touch on which counters your industry peers are watching closely.
Some of the core businesses in SA in the healthcare and life space, today they put out they updated the market, and it allayed a lot of those fears, talking about recovery in that margin and around new business. And so I think that's put that concern aside. And outside of that, you've got this core growth story that's building out. The bank is starting to turn profitable. They don't need to pump so much capital into that. And you've got some of their global businesses that are also, growing at a healthy clip. UK is doing very well. So I think you've got a stable core business, traditional core business, plus a number of growth drivers that have been built that are now starting to hit their straps in the rest of the business. So I think you're going to get mid-teens to upper teens growth in the next 2-3 years in earnings. And you're paying, on a forward earnings basis, you're paying like 12.5 times, 13 times next year's earnings. At that rate, I think it's pretty attractive. So that's my pick of that.
I mean, I think if you look at SAPI, it is a very cyclical kind of equity and very cyclical kind of business. And if we look at it on normalized earnings power, we think the equity is trading very cheaply. It's probably only ever been cheaper during COVID, when it was going through a period of balance sheet distress. And we think, yes, it probably does deserve to be cheap at this point in the cycle, given some of the cyclical headwinds it is facing across its segments along pricing and volumes. But having said that, post the Mondi update, we think SAPI did trade in sympathy with Mondi, but more a case of, if one had to think that the free cash flow generation wasn't necessarily going to be there, then maybe SAPI was trading with a bit of balance sheet distress. But to us, we think that those fears are overblown. We don't think that there's a balance sheet or a liquidity risk that is imminent in the business. We think management are viewing the balance sheet and the liquidity issues as something that's at the top of their agenda, and we do expect them to resolve that in the short term and therefore see a bounce in the equity.
So Sappi and Discovery, do you like those counters, Cobus?
I like both, yes. Discovery, I largely agree with Grant. Some fears around the margins in the, call it the core traditional business, seem to have allayed somewhat. And of course, the prospects for Bank and Ping An, that continues to be the growth story inside of Discovery, and it's historically cheap. This has been an expensive stock, but buying it on a 12.5, 13 forward, that's actually quite attractive. It's been a bit of a laggard. It's caught up somewhat, but it's decent value for what we're accustomed to with Discovery. Sappi, that's again calling the bottom of the cycle, and I've tried to call the bottom of the cycle early once before, maybe in the last 4 weeks or so. The severity of the lack of demand and the pressure on prices has caused Mondi to extend the maintenance on some of their plants, essentially extending plant shutdown time as they try to manage their supply into this pretty weak market. But I'd say Mondi is my preferred player, high quality management team, more robust balance sheet. But Sappi's also a great way to play this, perhaps a little bit more marginal. But ultimately, yes, I'm a buyer at this level, given that I think this market is probably bottoming out.
Yeah.
And I don't think it'll be available at this very cheap valuation for too long.
And I mean, Mondi was down almost 17% when it was out with that update earlier this week. People must just buy the dip at this point. All right,
Yes.
What else are you liking, Cobus? What are you hanging your hat on this afternoon?
There's a narrative around SA Inc. stocks being very cheap, and given that the bonds have rallied so much, even in the last 2 weeks, the cost of borrowing locally, the offshore buying has been incredible. It's offshore real money and offshore hot money, so-called portfolio flow money, buying into this market. Ultimately, the equities have given up. They've grown earnings. They've given up a lot of those post-GNU rally gains, the local SA Inc. stocks. And in the meantime, they've grown their earnings. So they are barely more expensive than they were before that rally. And just given that Remgro gives you access to a fantastic basket of those stocks. More specifically, they've restructured the Heineken business. They've sold off the Fiverr business, which was eating, it was quite capital intensive and perhaps restricting their ability to distribute dividends to their shareholders. They've sold that off to Vodacom, and it seems like Mediclinic's also staging quite a nice turnaround, so specifically in its offshore operations. So this gives you a 40% discount to those assets. It's quite wide historically for Remgro as well. And into a nice quality basket of SA Inc. stocks that I think, just given what everything around it has done, should start catching up.
All right, let's leave it there. Cobus, thanks so much for your time and taking us through trade this afternoon. That was Cobus Potgieter from Southern Cross Capital.